Hey there, welcome to another episode of Retirement Intel. We are live. It's Tuesday, 4 p.m. Central Time, like usual. Happy to be here. Happy Tuesday to everybody. Let's go ahead and get started here. Today, we've got a great show. Today, we're going to be talking about this retirement crisis that is mentioned all over the media. Whether or not we do have one, what can you do to help avoid that in your own personal situation? We're also going to be talking about why is retirement planning so hard. I mean, what is it about retirement planning that makes it difficult for people to actually execute? Is that the reason why we have this retirement crisis? We're going to talk about gambling versus investing. I hear a lot of people say that, by putting money into the stock market that they feel like it's gambling. And we're going to talk a little bit about whether or not it is gambling and how do those two actually compare. So buckle in. Let's go and get started here. Make sure if you're joining us for the first time, hit that subscribe button and make sure that if you have any questions, drop them in the chat. We'll get to whatever we can today. If you have questions throughout the show or after this, if you're watching this, you can always email us. The email's down in the description below. We're always happy to engage with our listeners, help out how we can. This whole show is designed around bringing you the latest and greatest in what's going on in the retirement planning industry. What's going on in news that can impact you and your long-term financial goals. So excited to do this every single week and make sure that you subscribe so you don't miss a single show. Next week, with it being a holiday, we might be off next week, but we'll be posting something out. So make sure that you're following us, on YouTube, on Facebook, on LinkedIn. We're going to go ahead and announce that over the next couple days. So now let's go and dive right in. One of the biggest and latest pieces of news in the entire financial industry is the fact that the Fed is likely to start cutting interest rates in the coming month. I know a lot of people anticipated that rates were going to start coming down in September, but Fed Chair Jerome Powell pretty much alluded to that the other day with his speech. So it looks like it's about time. We've had rates at these higher levels for some period of time now, and I think the question when we look back on this is whether or not the Fed is late to this game. Should they have been cutting already? Just like when we had the record high inflation a couple of years back, should they have been increasing rates? Because I think almost everybody can attest to the fact that they were late to the game when it came to increasing interest rates. They missed the ball when they should have increased rates months before they actually did. And now here we are, September 2024 is when they're going to start decreasing rates. So are they late to that game? If you're not familiar with what the Fed's trying to do, they're trying to thread the needle and make sure that they can, keep monetary policy tight enough to suppress inflation. At the same time, they want to start lowering rates at a pace that is just perfect enough to help avoid any sort of economic contraction or recession, as you might know. So one of the things that you're going to start seeing quite a bit over the next couple of weeks are probably going to be stories that look a little bit like this. How do you actually beat cash now that the Fed's going to be cutting rates? One of the biggest and most impactful investments over the past year and a half to 2 years has been the fact that now you can get yield on investments that are not in the stock market. For the longest period of time, bonds were giving you 1% to 2%. Cash in your bank account was getting, maybe 0.1%. And then money markets at the same time were getting very little. Now, there's some money markets that are well over 5%. But as the Fed starts to cut rates, those rates are likely to come down. So what should you be doing in advance of that? If you're sitting in cash, if you're sitting in investments, you're going to see articles like this. This is from Barron's, and you're probably going to hear a lot about what you should be doing in advance of rates coming down. So a couple of things that you might want to think about. In this article, they're talking about utilizing defensive stocks as well as dividend-paying stocks. Now, here's the issue with that. That changes your risk profile. So if you were used to 5.5% or 5.3% in a money market or a CD, and now you're going to a defensive stock or a dividend paying stock, your yield might be higher than what cash might be at some point. However, you're still taking volatility risk and investment risk when you're doing that compared to things like a CD or a treasury bond. If you're sitting in a money market, maybe now's the time that you want to start looking at individual bonds or bond funds. Especially even with where rates have been, one of the biggest disappointments from an investment standpoint has been investing in bond funds over the past couple of years, because as rates go up, the value of those bonds have gone down. So we saw a year like 2022 where the stock market fell and bonds lost money in that same year. But as we see rates come down, that's where we should see bond funds. And if you're holding bonds and you're buying them at a discount as they go down, they should start trading at a premium. One investment they mentioned that I was a little skeptical on was they talk about gold. And gold's this polarizing investment where people want to attribute it to this inflationary hedge, this this investment that's supposed to keep pace with inflation. It's supposed to act as a diversifier in your portfolio, and it definitely does that. But the one thing that gold doesn't do, it doesn't pay you any sort of dividend or income stream. It's just an asset class. So at a certain point, if you're never selling that to monetize those gains, over time, we've seen gold just fluctuate, between $2,000 an ounce to $1,500. We've seen it fluctuate over a period of time. And so the last thing they talk about in here is utilizing CDs, locking those rates in. So if you're in some sort of money fund right now that is paying a larger rate, locking those in by buying, whether it's CDs or short-term treasuries, is a great way to do that. Keep in mind, you're not going to have the same liquidity that you are when it comes to a money market. Money fund, you want to get out of it today or tomorrow. And it's, you just have to, just trade and settle it. Whereas with CDs and, short-term treasuries, you actually have to get out of them. There could be a penalty if you're investing in a CD. And at the same time, if you buy an individual bond and let's say rates go up slightly, then you might actually have to sell that at a discount. So just keep in mind, none of these investments that they're talking about here are like cash. These are not cash alternatives. These are not cash investments. This is just a way that they're talking about how you beat cash when the Fed starts cutting rates, because we know that money funds will likely start coming down in how much yield they're paying. So just keep that in mind as you're investing for your retirement, because, like I said, yields have been pretty good as of late, but at the same time, we know that they're going to start coming down, which, I think the Fed's a little late for this, but that's just my opinion. So let's kind of dive right into, really one of the main stories that I want to talk about today, which is the retirement crisis that we're seeing right now kind of play out with, what's going on with how much people actually have saved for retirement. There was, when you hear this term retirement crisis, what does this mean? And what studies have shown is that there's the inability for a lot of people that are not able to maintain their standard of living into retirement. And so there's this National Retirement Risk Index that I'll go through and show you, that they talk about the percentage of workers that can actually maintain their standard of living once they retire. And now, as you can see in the chart, it's only at 39% of working age households. It was in the 40s and 50s, but now it's come down to 39%. Now, they attribute some of this to rapidly rising home prices, savings during the pandemic, strong stock market gains, and some of these factors, as they fade, the index is likely to fluctuate between 40 and 50%. And this is all according to the Center for Retirement out of Boston College. They do a really great job in the research they do. But what they're showing is that roughly half of American households are at risk, is the fact that, when we look at how much people have saved, they just don't have enough saved for their actual retirement. Even when we look at, based on the income quintile, you take out the highest income quintile, what you'll find is that the majority of people that are in kind of that middle tier of income, their median 401k or IRA balance is $220,000. One of the arguments that they talk about in their research is that if this was a couple that was going to retire and they put that $220,000 into a joint life and survivor immediate annuity. So what that means is they put this into something that's going to give them and their spouse a lifetime monthly paycheck for the rest of their life. That would generate about $1,200 per month. And those aren't adjusted for inflation. So that's going to be an amount that's going to be eaten up over time due to purchasing power. But that's what $220,000 can get you. We think of the traditional 4% rule. If you were just to put that into, let's say, an account and invest that over time, and you're pulling 4% from that, that's $8,800 a year. So obviously not enough to retire off of for most people. And so that's where when we start hearing about whether or not there's this retirement crisis, there's a disconnect somewhere. And where is that disconnect? Why don't people have enough? But the interesting thing is that when they're actually asked whether or not they have enough, 80% of older households say that they have enough money saved or that they're doing okay to live comfortably. So the data is showing us one thing, that most people don't have enough to live comfortably or maintain their lifestyle, yet 80% of people are saying that they've got enough. So where is that disconnect? Do they not have enough, or are they just saying that they don't have, that they're okay because they just don't want to admit to whoever this survey taker is that they're really not okay? And so when they have a quote here, you're thinking about your saving over your life. So this is a question they actually asked all participants. They said, thinking about your savings over your life, do you think what you've saved was too little, about right, or too much? And what they did was they looked at this and said that this is considered regret in their mind. That most people have, when we look at this, they say that 52% of people say that they regret, how much they've saved. They regret not saving more. But the reality is, the way that question was phrased, I don't really look at that as a way that you're asking about regret. Of course, anybody who's asked later on in life, do you think you saved enough? Of course, you probably want to save more money. Most people, at any point, heck, right now, I wish I saved more money. I know that I'll say the exact same thing next year. I always wish that I had there was more money saved. And I think everybody can agree that. Do I consider that a regret? Not necessarily, but that's what they're alluding to. I think that's a little bit of a stretch. But the bottom line here is that with all this objective evidence, it does indicate that between 40 and 50% of people are not saving enough. And the interesting part is, so how do we fix that? There was the fix that everybody was supposed to say that was going to end this retirement crisis. You probably heard of this. Lawmakers had this magic fix that was the thought of auto-enrolling people into their 401ks, and that was going to help the savings rate. That was what was going to change the entire game. We were going to force people into their 401ks, and we're going to make sure that they auto-increase their contribution rate every single year, and that was going to fix this retirement crisis. Here's the problem. It didn't do that. In fact, there's been a number of pieces that have come out lately, especially this new research from Yale that's showing that it's not working like people had hoped. What they did is they studied 9 workplace 401k plans, and they found that auto-enrollment increases net contributions by 0.6% of income per year, and that auto-escalation increases the contributions by only 0.3% of income per year. So this isn't fixing this retirement crisis. Only 40% of workers with an auto escalation default actually increases their savings rate. Because what this auto enrollment does is that when an employee is hired, they have to opt out of contributing to their 401k or 403b, and they actually have to go in and opt out of that as opposed to opting in like they used to have to do. And at the same time, with the auto enrolled contribution increases, they have to also opt out of that. And so what it's saying is that only 40% of people are actually having their rates increase. So either they're going in and opting out, or There's a couple other reasons why they're attributing this. They're talking about frequent job changes and how, because Americans typically change jobs a lot, more frequently than most countries, it doesn't allow time for the increased savings rate to actually take place. Uh, they attribute this to cash leakage, which we've covered on this channel before, which is when people leave their employer, there's a big chunk of 401ks every single year that are just getting cashed out. So what they're doing is they're taking money out of their 401k, and they're just cashing it out, using it as cash, putting it in their bank account, and that's one way that we're seeing 401ks amounts from a savings perspective decrease. They're also talking about how vesting requirements also diminish the effects of of this auto enrollment. So it's not this magic bullet like everybody thought it was going to be. And I do wonder how many people are actually under saving because of the fact they were auto enrolled, and in their mind they thought, well, I'm putting money in the 401k because that's what the company told me to do, or they forced me to do, and I don't want to go in and opt out because I know I should be saving something. But what if they could actually save more? And this is where, instead of having this one size fits all, in retirement planning, there is no one size fits all answer. So because it is unique to each individual, it's important to make sure that, if you're auto enrolled into the 401k, maybe you could save more, and maybe that's something that, instead of just going with the default of whatever the company sets you up with, taking the time to make sure you're analyzing your specific, your specific situation to make sure that you're saving as much as you can. That kind of brings us to, the real question, which is, why is retirement planning so hard? This is something that I hear all the time when talking to people that are focused on retirement, that it's just hard. It's hard to think about. On the surface, it seems extremely simple. Earn money, save money, invest money, let it grow, and then spend it when you're in retirement. Retirement sounds simple, but it's not that simple. It's, there are difficulties when thinking about it. And the number one investment that a lot of people don't think about is your ability to actually earn money. This is the one that people overlook. They always think about, okay, well, what percentage of my earnings should I save? What type of account should I save in? Should I be in a Roth or a traditional? Should I save money in a brokerage account, or pay off my home early? Where should I be spending that money from a savings perspective? How should I invest it? They're always focused on this stock or that fund, or how to grow it as fast as possible. And even on the spending side, people always think about, well, is the 4% rule what I should be using, or how much can I spend of my savings? But a lot of people forget that they're focused on the other four, when the first one, spending your time focusing on how much you're earning and putting effort into that, that's your biggest investment, because that's the leverage point that everything is going to be based on. If you're able to save 10% of how much you make per year, well, 10% off of 50,000 is half of what it is at 100,000 or 150,000 or 200,000. And so we're no longer in the days where a college degree is a requirement to earn good money. Nowadays you can learn a lot from places like YouTube, places that you don't have to necessarily go to college to become an expert at certain things to earn a good living. I know a lot of very well-off people that are in trade, whether it's roofing or welding, you name it. So it doesn't necessarily have to be, go back to college and, get in a massive amount of debt and spend 4 years of your life just to go back to college. There are ways where you can invest in your knowledge base and just hone a craft to earn more money. But there was an interesting article by one of my favorite writers in the investment space, or really the personal finance space. His name is Ben Carlson, and one of my favorite articles that he recently published was "Why Don't People Save Enough for Retirement?" It's a really good article, and he attributes it to a couple different things. There are a number of factors that he kind of attributes the reason why people aren't saving enough for retirement. And one of the things that was interesting is that he has this graph here that talks about the average retirement balance by age. I'm not gonna lie. I think graphs like this probably hurt that case, because no matter what, when you're looking at a chart that says, well, at this age I should have X, what happens if you're behind the eight ball? It's hard to always feel, if you're not doing enough, what happens? And so it's just something that can weigh on someone's mind when if you're behind on the investment front or the savings front. But one of the things that was important that he pointed out here was that regardless of your age, uh, confidence increases as you get older. But what was interesting is that if you take a look in this middle column here, the percentage of adults who think that their retirement savings is actually on track never hits even 50%. So at any point throughout life, less than 50% of people actually feel like their retirement's on track. And one of the things that he talks about are the five reasons. The first one we kind of touched on was you don't make enough money. Yes, of course. There's always the ability to and the thought to try to earn more money. You're overwhelmed. This is a big one. This being overwhelmed is tough because there are so many choices. There's not one right answer to determine how you should be saving, what type of account you should be saving in. There's a lot of different ways to think about it. He talks about procrastinating. We always feel like there's always going to be more time. There's always going to be more time. I can always make it up. If you're in your 20s, well, you know what? I can save in my 30s. When you're in your 30s, yeah, you know what? I've got a house, I've got kids, I've got life. I can start saving in my 40s. And so there's always that procrastination that can come into play. The other part is that you don't know how to save. And this is common. And a lot of people don't really want to admit this. It's hard to know exactly how you should save, what type of account. Should you be going into a brokerage account or a taxable, tax deferred account or a Roth? And there's so many different types of accounts, and it can get really confusing to know whether or not you're doing the right thing or not. So that is always hard to just know the basics of what type of account do I save? Where do I get started? And so, the last one he talks about is having family obligations. And there was a really good piece in the Wall Street Journal that had talked about, it was an article where the author was talking about how he's a 37-year-old, hasn't saved enough for retirement. What does he do? What do I do? And so where this article started was, how he talked about, where do you prioritize your retirement? Where does that, come into play when you've got a family, when you've got kids, when you've got just life? And so, it is always hard to figure out, what do you prioritize? Do you think about, we all pass something along to our kids that's based on the shortcomings of, our own upbringing. That could be anything from, for me, I grew up and I didn't have the fancy shoes or the fancy clothes. I mean, heck, when I was in high school, everybody was wearing Abercrombie and Fitch, and I just couldn't afford it. And so, as my kids grow up, I want them to have the nice clothes and the nice shoes. And I know that might be, something that is, some might look at it as silly or not the smartest thing, but we all pass something down. For some, it could be experiences. Some people might think, you know what, I never went to Disneyland with my parents. And so, maybe I want to take my kids there. But the younger generation now, the millennials, and possibly some of the Gen Xers as well, they know what it's like leaving college with mounds of debt, which is something that I know the baby boomer generation doesn't necessarily have experienced like these other generations. I know there's student loans have always been around for a long time, but the younger generations are dealing with mounds of student loan debt. And so the thought of that being a shortcoming when raising your own kids, of course, I don't want my kids to leave school with this massive amount of college debt. And that creates this other wrinkle of, well, where do I prioritize? Do I save money into my kid's 529 plan, or do I put money into, my 401k? Where do you prioritize those dollars? And so, Ben points out that, one of the things that was interesting in this piece was that instead of thinking about trying to take on too much risk to double your rate of return, he points out that if you were to double your savings rate, that is actually more powerful than doubling your investment rate of return. So let me put that here on the big screen so you can kind of see that. Um, so if you take a look, if your savings rate was 10% and your investment rate of return was 6, and this is assuming that you made $100,000 and that increased 2% per year, based on inflation, after 10 years, if you were to double your savings rate, you'd have $287,000. But if you were to double your investment rate of return, you'd have $192,000. So the best thing you do is always focus on the savings rate, and I think that's a really good way to look at it, because with all of this talk of whether or not we're in some sort of retirement crisis, whether you're caught up in that, whether life's just gotten in the way, what do you actually do about it now? That's really the question. What should you be doing about it? If you're one of the people who are like that author who've just felt like you haven't saved enough, you're looking at all these different articles out there that you should have X amount in your 401k by the time you're 30 or 40 years old, and you feel like you're on the wrong side of that. Well, then what do you do? Obviously we talked about focusing on trying to make more money in some form or fashion. None of this, as we talked about, none of this is about the investment portfolio or choosing this stock over that stock. It's really about prioritizing what your individual goals are. That's really what it comes down to. Think about it like that credit card, waterfall method that people talk about. If you're paying down a bunch of credit cards, do you make a little bit of payment to each one of them, or do you tackle the highest interest credit card, pay that off, and then apply that, all of that to the next credit card and the next one? Same thing with your goals. Attack one of your main goals, and then from there, make sure that you're, prioritizing that as the number one goal, and then from there you fund the next one. But no matter where you're at, no matter what stage of life you're in, it's important to have some sort of plan of where you're saving money. It doesn't have to be this complicated budget where you're analyzing every single dollar every single month. As nice as that would be, let's just face it, it's just not practical. Most people, they don't like having a detailed budget. It's an exercise that is like giving blood. Nobody likes needles, at least I don't. But most people don't like budgeting. And so, having some sort of savings plan to know, okay, what goals do I have? And knowing whether or not those goals may be unattainable, but it's important to know that they're unattainable so you at least know what's possible. Because, if you're saving for, let's say right now, you're splitting your savings between, college savings plan and your retirement, and you look up and go, okay, well, both of these are off track. Now, this is what's attainable to help my kid through college, and this is what my retirement's going to be. Is that going to be enough, or do you have to make some course corrections? It's better to course correct years in advance than it is to just wait till the very last minute, have your kid be 18 years old with the cap and gown, and then you go, hey, guess what? We have about a third of what we really need to actually send you to college. So, or getting close to retirement, and next thing you know, you're thinking, hey, I want to retire at 60 or 62 or 65. You get to that age and you look up and you go, hey, guess what? We don't have enough. And you're hoping that your employer will keep you around for, another 5 or 10 years. So it's always important to just have some sort of plan in place. If you don't, and you have questions and you just don't know where to start, there's a link in the description below. We're happy to help out with that. We can run a free retirement analysis for you just to show you where you stand, help you prioritize those goals. There's not going to be any sort of cost to that whatsoever. So use that link in the description below. We're happy to help with that. And anytime, we do these live shows every single Tuesday. And if you have questions, you can always just throw something into the live chat, or afterwards, you can send us an email. We're always happy to answer any sort of questions. We want to be a resource to help you plan your retirement, which kind of brings us to, we're going to kind of shift gears and start focusing on the investment side of things, which is whether or not, is gambling is that actually something that is similar to investing? What is the difference? We see this, all too often where people have attributed, that by investing there's some sort of gamble there, and this isn't saying that you're going to see your investments go straight to the moon or straight to zero, or that it's some sort of gamble. But there's a new research paper that just came out about a week ago. It was called "Gambling Away Stability: Sports Betting's Impact on Vulnerable Households." And what they looked at was that since 38 states have legalized sports gambling, there's been last year in 2023, there was $120 billion in total bets and $11 billion in revenue that was generated for these online sports betting companies. That's a lot of money. That money's got to come from somewhere. And so what the authors did in this research paper was that they looked at a quarterly panel of 230,000 households in the states that have legalized gambling. And what they found is that 7.7% of households made online sports bets with an average household bet of $1,100 per year, which is a lot more than what I thought it would be. And what they actually found was that by doing this, it actually reduced the amount that people were putting into brokerage accounts. And so they were actually able to attribute, and compare states that have legalized sports betting to states that have not, and the amount of money that was being put into brokerage accounts. And so it was going to sports betting as opposed to investing. They say that legalization reduces net investments by bettors by nearly 14%. And like I said, I hear people talk about investing like it's gambling all the time. There's a very, very big difference. Yes, there's risk involved on both sides. Obviously there's risk when you're gambling, and there's risk in the stock market. But the difference is that, gambling for most people, it should be some sort of form of entertainment. For most people, investing isn't entertaining. If you're watching this, you're probably more focused on when you're going to retire than you are what's happening in the S&P 500 or the NASDAQ or any sort of specific investment. A lot of people don't find investing as entertainment. But there is this thrill that people have when they're seeking to just double their money in an afternoon, and it just becomes a little bit more mundane when you start thinking about earning a modest percentage rate over the course of an entire year. If we look, the historical average for the S&P 500, somewhere between 9 and 10.5%, depending on when you start and stop that. That doesn't sound like a lot of fun when you think of, well, I can double my money if this team hits a field goal. So the difference is that when you're investing, it's not a zero-sum game. Whereas with gambling, you could lose it all. Whereas, there was an interesting chart from American funds that showed that when you look at the odds of a positive rate of return, so over a 1-year period, the odds of a positive rate of return were about 70%. When you look over a 3-year period, 73%. When you look at a 3-year period, the odds of a positive rate of return were 84%. 5-year was 88%. 10-year, 94% probability of a positive rate of return. We haven't gone through, they don't have it on this chart, but there's never been a rolling 20-year period in the S&P 500 that's been a negative number. And so when you think about that negative, that doesn't mean zero. Whereas when you're gambling, when you lose, that's zero. There's not, yes, there are companies that go out of business. There are investments that have gone to zero. But for the most part, when you're in a diversified, investment basket, you can have one company out of the S&P 500 that goes bankrupt, but that still leaves you 499. If your kicker misses that field goal to cover the spread, well, guess what? That means you ended up with zero. And so that's the big difference. Don't look at investing like it's gambling. Yes, there's risk involved, and it's always important to understand what those risks are. But at the same time, if you're investing the right way and you're investing in a diversified portfolio with high quality investments, then it's not this zero-sum game. But remember, investing is also not this get rich quick scheme. It's not something that you're going to try to put $1,000 in and hit the jackpot and try to triple that money in the course of a few days or a few months. it's something that's going to compound over time. So that's the power of that, that compounding. That's what is the reason why, trying to save and invest early on in your life is important, but it's very different than gambling. But I thought it was fascinating to see how, that legalization has reduced the net investments by bettors by 14%. So you think, going back to that retirement crisis, if you're able to add 14% back to your savings, whatever it is, depending on your income, that's probably not an insignificant amount if you're able to compound that over time. Yeah, it's probably boring, especially with football coming up. It's probably not going to be as entertaining as some of the games that we see. But if you're focused on not being in that sub 50%, that is no confidence in their long-term retirement picture, then I would say focus on the savings, focus on how much you're making, make sure you put together a plan, and just know we're always here as a resource to help you. There's a link in the description below. We're going to do these shows every single Tuesday. We're going to try to be here next Tuesday. We'll be traveling with the holidays, but we'll be posting about a change in next week's show. But no matter what, we're going to be here weekly, maybe just a different time. But if you're watching this, thank you again. Hit that subscribe button. If you have questions, shoot us an email. We're always here, and our team is happy to help you at any point. So with that, have a great Tuesday evening and a great rest of your week, and I will see you soon.